What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are looking at what will happen to your pension in a currency reset. Recently, central banks all around the world, including the IMF, have been talking about a transition to having central banks issue their own digital currencies, and I made a whole video about that event specifically. And so today what we are going to be looking into is the effect that that will have on pensions and more broadly retirement accounts like 401ks, social security income, fixed income retirement accounts like annuities, and pensions. Ready? Let's dive in. All right, so like I mentioned, I have a video that I made that is strictly about the monetary reset overall. And if you haven't seen that, it's linked in the description below. I encourage you to watch that in addition to this. And so we're looking at what happens to retirement accounts in the event of a currency reset. All right, so the first thing that we need to understand to answer the question, what happens to your retirement account in a currency reset? Basically, first we need to know what is a currency reset or a monetary reset. And essentially, it's when a money gets replaced with a new money. That's the most basic explanation of it. And we've seen this happen dozens, if not hundreds of times throughout history when a country or a civilization is using a money that for one reason or another becomes worthless, it eventually gets replaced with another money. Now, most times throughout history when a new money comes in to replace an old money, it's usually something like gold or silver. Now, sometimes governments do try to put in a new fiat currency or a new paper currency that is not backed by gold or silver. And every time that they've done that, it's failed just as quickly, if not quicker, than the original currency that failed before it. It's not until a government issues a new currency that's backed up by something of hard value like gold or silver that it actually sticks. But that doesn't stop them from trying. And so that's one of the likely outcomes here as the entire world is in a race to devalue their currencies as fast as possible, that the outcome is that these central banks and governments decide, hey, well, it was, political issues or rich people issues, or they'll blame it on one of a number of reasons why the currency failed the first time, not because they printed it into oblivion. And so they'll say, hey, with this new currency, we've solved those issues. And so the same thing won't happen this time, even though it is fiat again. And that fiat can come in any form. It can come in the form of a digital currency or a paper currency. It really doesn't matter if it's not strictly backed by something that absolutely limits its supply or the creation of new units. What this means is that the effect that some event like this will have on a retirement account like a 401k or a pension or your social security or an annuity, really the biggest effect of this happens in the lead up to the currency reset. The actual event where Federal Reserve notes are swapped for Treasury dollars or the Fed coin or another currency from another country like a euro or the Chinese yuan, that actual event has really no effect on anything. It's really the lead up to that event that causes all of the problems for people living off of fixed incomes. So here's what I mean by that. You can take your 401k, look at all the investments inside it, whether it's mutual funds or stocks or bonds, and you can price them yourself using anything. You can price them in Bitcoin. You can price them in gold. You can price all of your mutual funds in euros yourself. All you have to do is take the current exchange rate of dollars to yen or dollars to gold, whatever that exchange rate is, and you can value your 401k in whatever money you choose to value it in yourself. That has no bearing on the amount of stuff you can buy with your current retirement account value. If you're currently getting Social Security checks worth $1,000 every single month, you can take that and turn that check into dollars and go spend $1,000 and get $1,000 worth of stuff. If you want to measure that in terms of gold or yen or euro, you can go exchange that check, that $1,000 check, for dollars, then exchange it for the other currency, whatever money you're valuing it in, and then exchange that back into dollars, and you still have $1,000 minus the exchange fees. And so the actual event where the money gets changed out for a new money doesn't do anything. It has no bearing. So what we're looking at, what we're concerned with, is the lead up to that. What causes, what are the sequence of events that cause that to happen, and how does that affect your retirement account? Well, essentially, what we're looking at here, this sequence of events, is basically just a number of events that are all fall under the umbrella of inflation. Now, the definition of inflation has been shifted and changed over the last 100 years. You look at dictionaries from 100 years ago, and you'll find that inflation meant the expansion of the money supply. And so, in a central bank or through the expansion of bank credit, if the total amount of money in a system expands, then that is what the definition of inflation was. Similarly, when the total supply of money in a system contracts, that was called deflation. Now, one of the results of inflation or deflation was the effect that it had on prices. And so typically, when the supply of money in a system increases, you would see a corresponding rise in the general level of prices. And then similarly, when the total supply of money in a system contracts, you would see a corresponding decline in the general level of prices. And that's simply a matter of supply and demand, more or less money chasing the same amount of goods and services. This is why when our country, the United States, did not have a central bank from the time period of the end of the Civil War through the creation of the Federal Reserve in 1913. That was a period where the money supply stayed generally the same, and because of that, people got more and more stuff for the same amount of money. There was the same amount of money, but more stuff. There was growth, and so things got cheaper and people got wealthier as a result. So we know the effect that monetary expansion has on the general level of prices. So what does that do for your retirement account? Well, it depends on the type of retirement account you're talking about here. Let's start off looking at a 401k filled with all stocks. In general, the effect of monetary expansion or inflation on stocks is it makes the price go up. Now, I'm not talking about purchasing power for a second. I'm just talking about the price. Because if you have a company and nothing changes in the value of the company, but the total dollars or total amount of money in the system doubles, well, then the price of the stock has to double in order to compensate for the amount of money in the system. That would keep its value the same, and that would mean that the purchasing power, if you sold your shares of that company, would also stay the same. And so as more and more money is printed and put into the system, that pushes the price of assets higher. Now, in this video, we're talking ceteris paribus, all things being equal, right? And so I'm not talking about, well, what would happen in a stock market crash or anything like that. I'm just talking about the effects of monetary printing and inflation on different forms of retirement accounts that will eventually result in that currency becoming worthless and being swapped out for a new currency. And in general, that process makes stocks go up. And that's why when you look at the stock markets of countries that have had episodes of hyperinflation, like Venezuela and Argentina and Zimbabwe and the Weimar Republic in Germany, you see their stock markets just going parabolic, just skyrocketing up. And that's just because it takes more and more of ever increasingly worthless currency to buy those same companies. When you measure those same stocks with other currencies, you don't see that same straight move up. But in terms of the local currency versus those stocks, yeah, it's going to be a straight line up. The amount of real stuff you can buy with a 401k full of stocks might go down, but it's not going to go down as much as that same amount all in cash. Because you still own equity in companies that are still, they have real people running companies, selling real products, changing their strategies, maybe moving locations to other countries that are more attractive to business. And so you still have ownership in these companies versus cash. It goes to zero, just gets printed into oblivion. So that's one type of account. Now, let's say you have a retirement account that's invested in bonds. Well, bonds are tricky because bonds have a maturity date, and that means that bonds are repaid at some point. Now, a bond is just debt. So if I loan you $100, you owe me $100, right? And so let's say you're paying me 1% interest. That means when the loan comes due, you're going to give me $100 plus one extra dollar. You're going to give me $101. Let's say I need the cash and there's another investor that wants to invest in something just like this. And so I sell this bond to my buddy and he buys it from me. So he pays me $101 because that's how much I'm going to get. That's how much I want to sell it for. He's okay with that. He buys it from me for $101. You don't owe it to me anymore now because he bought it from me. You owe it to my buddy. Now, how much do you owe my buddy? The same thing. $100 principal plus your 1% interest, $101. Now, what's his interest rate? 0%, because he paid $101 for something that he got $101 back for. That means his interest rate is 0. So there you see a floor. Can't really get much higher than that. That bond can't be worth more than that, because nobody's really going to buy that from him at $102, because when you pay it back, they're only going to get $101. So then they're going to have a negative return on their capital. Now, if you've looked at the price of bonds recently, they're all pretty low. And so there is a lower bound threshold for interest rates at 0%, because really outside of a few conditions, nobody in their right mind is going to buy negatively yielding debt unless they're forced to, because they're, in some sort of national pension plan, or because they're a central bank and they can print money and they don't care. Outside of those two things, nobody's really going to buy negatively yielding debt. So there's a cap on how high bonds can go, versus with stocks, there's no technical cap. What this means is that in a world of inflation, when there's more and more and more money being printed, yet there's a central bank that's buying up bonds to keep these bonds at elevated prices, it means interest rates can't compensate for the amount of inflation, meaning that anybody who holds on to debt, they're getting paid back in dollars that are not going to buy them as much stuff as they could when they originally made that bond purchase. That means that if your retirement account is full of bonds right now, yes, you're going to get your principal back. Yes, you're going to get your interest back, but the amount of stuff that you can buy with that total account value is getting less and less and less as time goes on, because everything else in life is getting more and more expensive, but your bond portfolio is staying the same value. If your bond portfolio is paying you 1% or 2% interest every year, but your cost of living is increasing by 3 or 4% every year, that means you're actually losing 1 or 2% every single year in terms of real purchasing power, and that's all that matters. Now let's take it up a notch, because it gets even worse. Let's say you're on a fixed income, so this is Social Security or a pension or an annuity. These types of retirement accounts, sometimes they're pegged to inflation, but the real inflation numbers are always higher than what the official numbers state. And so they'll increase a little bit the amount that they're paying you, but it will never increase as fast as the money is being destroyed. And so you're getting your $2,000, your $3,000 in fixed income checks from your Social Security, your pension, your annuities. And right now that might be enough to pay your monthly expenses. But within the next year, 2 years, that might only be enough to pay for your rent or your mortgage. And then give it a couple more years beyond that, that might only be enough for one stop at the grocery store. Give it a few years after that, and it might not be worth enough to buy really anything. And that is the point. Once people stop accepting it, because there's just so much money in the system that a couple $1,000s is absolutely worthless, and they don't want to accept it for their goods or for their services. Once you can't buy anything with it anymore, that's the point at which a currency reset happens. And the government, by law, says, hey, everybody take your Federal Reserve notes, turn them in, and for every 1,000 Federal Reserve notes you turn back in, we're going to give you one new Treasury dollar or one new Fed coin. And that's just an arbitrary exchange ratio that I pulled out of my head. But typically when there is a currency reset and money is exchanged for a new money in a system, it is done at some sort of extremely high exchange ratio like this, because there'd really be no point to do it at the same ratio. Otherwise, you're creating a new money with the exact same supply as the old money, and there was too much of the old money. And if it takes you 1,000 old dollars, 1,000 Federal Reserve notes to buy a gallon of milk, well, then it'll cost you one new Treasury dollar or Fed coin or whatever it is to buy that same gallon of milk. So the actual event, you're not losing purchasing power. That actual event, you're not losing anything. It's the lead up to that that really crushes anybody on a fixed income, that really crushes the value of the old currency. So you might be looking at this and thinking, well, how do I protect myself against this? Well, number one, a start would be to eliminate your reliance on any sort of fixed income. Invest in assets that have income that actually appreciate along with inflation, like real estate, like cash flowing real estate. Another way to protect yourself against it, if this is your only option, is to buy stocks instead of bonds, because as we saw earlier, stocks have some built-in inflation protection. They're not going to expire. They don't have a set maturity date, and they don't have a floor on the interest rates or a cap on the actual price due to redemption. Further than that, they actually have, their businesses with real products that, they might crash 50%, 60%, 80% in terms of real purchasing power, but you still own a company that eventually can come back, versus owning something that gives you a worthless currency will always just forever be worthless. And finally, you can protect your wealth by owning things like gold, because historically, gold has survived through currency collapses and it maintains its purchasing power. We've seen lots of currency collapses throughout history, and despite all the different types of governments and regimes and geographic locations and times in history, regardless of technology, gold maintains its purchasing power through all of it. And lastly, you can give yourself a little bit of an upside potential by investing a small portion of your portfolio in something like Bitcoin that has a really high upside potential if people do start using Bitcoin as money. And if they don't, it goes to zero and you only lose the small amount that you allocated to it in the first place. Now, please understand, none of this is advice. I'm not recommending any specific investment allocation or trade or investment for any specific individual. This is meant for educational purposes only. As always, I really appreciate you guys. You are the best. Have a great day.